Welcome to Tikona Capital FinServe's Market Outlook for December 2024. I'm excited to share our comprehensive analysis of the recent market correction, the emerging signs of recovery, and the strategic opportunities we see ahead. At Tikona Capital FinServe Private Limited, your investing co-pilot, we provide comprehensive wealth solutions for working professionals, HNI clients, and family offices. Our philosophy centers on creating finite solutions in an environment of infinite financial possibilities. Important disclosure: investments in securities are subject to market risks. Please read all documents carefully before investing. This presentation should not be considered as investment advice. Please consult your financial advisor before making investment decisions. Past performance does not guarantee future results. For information and detailed disclosures, visit our website at tikonacapital.com. India stands at a significant economic crossroads, shaped heavily by the potential policies of a new Trump administration. This outlook will have a mixed impact, creating both clear opportunities and distinct challenges across key sectors of the Indian economy. Starting with the opportunities, India's manufacturing sector is poised to benefit as US companies seek to diversify their supply chains away from China, potentially directing significant investment here. Conversely, the IT sector may face headwinds from stricter H-1B visa policies aimed at prioritizing American jobs, though improved US growth outlook could help offset this risk. The auto sector could see changing investment patterns, with reshoring being a risk, but also an opportunity as firms diversify from China. Pharma may see a push for affordable generics benefiting Indian manufacturers, even amidst a protectionist stance. Defense, however, is a clear positive, with shared security goals against China likely strengthening US-India partnerships. To understand the present, we must remember the past. Indian markets have faced several major corrections. From the Harshad Mehta scam in 1992 and the dot-com bubble burst to the 2008 global financial crisis and the COVID-19 panic in 2020, each fall of 30% or more was followed by recovery, underpinned by reforms, stimulus, and resilient economic fundamentals. Each crisis had a unique trigger but a common outcome: strengthening the system. The 1992 scam led to a stronger SEBI. The 2000 bubble filtered out weak tech firms. The 2008 crisis saw aggressive RBI rate cuts. The 2020 pandemic prompted massive government stimulus. Each time, the market and the economy emerged more robust, teaching us that crises are opportunities in disguise for disciplined investors. So, how are markets performing as we close out 2024? Let's look at the recent data to gauge the current sentiment and performance across indices and sectors. Global economy. The US economic agenda centers on extending tax cuts, reducing the corporate tax rate to 15%, and potentially eliminating taxes on tips and social security benefits. However, economists warn this, coupled with tariffs and mass deportations, could reignite inflation by acting as a sales tax on consumers and tightening the labor market, forcing wages up. Recent US data shows a mixed picture. While 146,000 jobs were added, the least in 3 months, key indicators like the 10-year and 2-year yield spread remain in positive territory, suggesting a low near-term risk of recession and a potential path for economic recovery. Globally, India leads with the highest inflation and policy rates. Other major economies like the US and Eurozone show more moderate levels, indicating a balanced approach to stability. Japan continues its unique path with near-zero rates, highlighting the divergent global monetary policies. US key signals are turning positive. The yield curve is no longer inverted, which significantly lowers the near-term risk of recession. At the same time, inflation continues to trend down toward the Fed's target, all while unemployment holds steady, a classic sign of a potential economic soft landing. China faces significant pressure. Proposed tariffs of up to 60% threaten its export-driven model. With the US and EU increasing trade barriers, China is forced to pivot towards high-quality development and boost domestic consumption to avoid long-term stagnation, creating a vacuum in global supply chains that India can fill. Oil prices traded above $72, reflecting a slow recovery in China and anticipation of OPEC+ decisions. This price stability, albeit with a slight upward bias, provides some predictability for India's import bill. Indian economy. Now, turning to India. Our economy is primed for growth in this Amrit Kal, driven by a powerful demographic dividend, rapid digitalization, and an enterprising spirit. This young, digital India is our core structural advantage. India's greatest economic asset is its people. We have a young and growing working age population, creating a powerful demographic dividend. This provides a massive tailwind of labor supply, consumption demand, and entrepreneurial energy, primed to drive sustainable economic growth for decades to come. Recently, Q2 GDP growth slowed to a 7-quarter low of 5.4%. While economists doubt sustaining 7% plus growth this year, achieving even 6.5 to 6.7% growth in this complex global environment is a testament to the economy's resilience. The long-term forecast remains strong. India is expected to grow at a steady rate of 6.5% till 2029, setting a firm foundation to become the world's third-largest economy by 2050. High-frequency indicators are robust. GST collections showed a steady 8.5% year-on-year increase in November, signaling strong economic activity. The manufacturing PMI, though dipping to 56.5, remains firmly in expansion territory. A majority of the economy remains on a positive footing. Government spending, investment, and exports are strong positive drivers, even though private consumption has shown some weakness recently. Credit growth tells an interesting story. Credit to small and medium-sized firms is outpacing large firms, indicating broad-based economic activity. However, personal loan growth has slowed, reflecting a cautious but healthy consumer leverage environment. The government's continued thrust on capex, high-capacity utilization, and business optimism are creating a virtuous cycle, auguring very well for a revival in private investment activity. Production-linked incentive schemes worth over 2 trillion rupees across 14 sectors, plus another 0.7 trillion for semiconductors, are a powerful catalyst, designed to make India a global manufacturing hub. India's innovation engine is firing. With well over 100 unicorns created in the past decade, the bulk in the last 5 years, we are witnessing an entrepreneurial boom that is diversifying our economic drivers. Manufacturing is the key to transitioning from a middle-income to a high-income nation. History shows that resource-rich nations like Brazil or Malaysia fell behind, while those that mastered manufacturing, like South Korea, sustained growth. India is now latching on to this critical trend. And it's working. India's merchandise export market share is expected to double from 1.8% in 2022 to 3.5% by 2031, with high growth in engineering goods and electronics, proving we are becoming a credible global supply chain alternative. India is comprehensively addressing legacy bottlenecks, from infrastructure to compliance, making it structurally ready to capture a larger share of global manufacturing. Markets in November 2024. In November, all major indices ended in the red, with the SME IPO index being the least impacted, showing a flight to more niche segments during broader market weakness. Sectorally, it led the recovery, a sign of resilience, followed by a small bounce in PSU banks. This rotation indicates investors are hunting for value in sectors with washed-out valuations. Globally, the US Russell 2000 Small Cap Index was the best performer, followed by the Nasdaq, showing that despite headwinds, optimism in US growth and tech innovation remains strong. FIIs continued their aggressive selling in Indian markets. Notably, for the first time in a long while, even domestic mutual funds were net sellers this month, indicating a broad, albeit likely temporary, risk-off sentiment. Massive fundraising in the IPO market continued, but the frenzy cooled significantly. Mainboard IPO average subscription fell to 1.9 times from stratospheric levels, and SME IPO subscriptions more than halved, signaling a return to sanity and a more discerning primary market. Strategy-wise, the Nifty Growth Sector's 15 was the best monthly performer. Yearly, the Mid-Cap 150 Momentum Index has outperformed, showing that quality growth and momentum strategies have held up well despite the volatility. The trend of financialization is undeniable. Over half of all unique domestic mutual fund investors have joined in just the last 3 years. There's also been a sharp jump in folios for sectoral and thematic funds in 2024, showing investors are becoming more sophisticated and targeted. In terms of performance, small cap funds recovered the most in November, while thematic funds performed relatively better than other categories, indicating a stock picker's market where specific themes are working. On the debt side, gilt funds outperformed, anticipating rate cuts. In hybrids, children's funds were the best monthly performer, a category often chosen for long-term, goal-based investing. Opportunities or market outlook. A key fundamental support for the market, corporate profits as a percentage of GDP have hit a 15-year high in 2024. This is a powerful underpinning for market valuations. The market capitalization to GDP ratio, a broad valuation measure, sustains above its long-term average. This highlights the built-in optimism about India's long-term growth potential, even after recent corrections. Corporate India's health is exceptional. We are seeing rising profits coupled with declining debt, creating the strongest balance sheets in a long time, which provides a buffer against uncertainty. The formalization of the economy continues. Taxable incomes have risen by 10 percentage points in a decade, and the number of total tax filers has grown at a 4.4% CAGR over the last 5 years, broadening the tax base and strengthening government finances. A monumental shift is underway. Equities as a share of Indian household assets have grown 2.6 times in the last decade. Yet, compared to global peers, we still have immense growth potential, meaning this flow of domestic savings into equities is a structural, long-term trend. The real estate cycle is healthy. Housing sales in top cities are expected to grow at 10%, supported by very low inventory levels. This is a multi-year upcycle driven by affordability and a desire for real assets. India's external position is robust. The RBI's forex reserves are estimated to swell by $53 billion to nearly $700 billion, providing a massive buffer against global currency volatility. With the US Fed expected to pause and eventually cut, the RBI is likely to follow suit. We anticipate rate cuts in India by the fourth quarter of CY 2024, which will be a significant tailwind for growth and equities. This earnings season, a larger proportion of small caps, 21%, have seen profit upgrades compared to just 11% of large caps. This suggests that the broader market's earnings recovery could be sharper, offering potential alpha. Strong earnings growth is what makes India attractive. Several sectors are expected to see 10 to 20% earnings growth, outperforming many other global markets and justifying premium valuations. Nifty's consensus earnings growth estimates are outperforming historical trends. This strong APE's growth is the fundamental bedrock that supports market performance and higher price-to-earnings multiples. Valuationally, the Nifty 50's forward PE is near its long-period average, offering reasonable value. However, mid and small caps, despite correcting, still trade at a premium, suggesting a need for more selectivity in that space. We believe investors should focus on these multi-decadal themes to build wealth: globalization via manufacturing and China Plus One, rising consumerism and discretionary spends, the formalization of the economy, the clean energy transition, the financialization of savings, and the ongoing technology boom. These are powerful, structural waves of value migration. The quarterly corporate earnings picture is improving, setting the stage for a strong earnings cycle ahead, driven by the themes we just discussed. In summary, we have seen a healthy market correction. While headline indices are down 10 to 12%, many individual stocks have corrected more than 15%. However, the India growth story remains intact on its path to becoming the third largest economy. Improving global growth, a softening rate environment, and political stability from the recent state elections are positive catalysts. Sectors like financials, specialty chemicals, and consumer durables offer a better risk-reward at this juncture. Key risks to watch are geopolitical conflicts, volatile food inflation, and interest rate volatility from new US trade policies. We remain convicted that adopting a focused, bottom-up strategy is key to navigating this market and building long-term wealth. Our conviction is captured in our theme, Nifty 250. Despite near-term challenges, India's potential is immense. Adopting prudent risk mitigation strategies in a long-term perspective is crucial for capturing this growth and achieving sustained investment success. At Tikona Capital Finserv Private Limited, we believe in creating finite solutions in infinite possibilities. Our triangle logo represents filtering out unknowable edges from the ultimate circle of market uncertainty. Founded and led by Sumit Poddar, our team is committed to empowering customers to invest in high-quality businesses and build long-term wealth. Connect with us at ticonacapital.com. Follow us on LinkedIn, YouTube, and Twitter. Thank you for watching, and remember, invest with conviction, build long-term wealth.